Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
Okay, so let's just start with the numbers. GameStop Corp, GME, is trading right now at about, $20.72 a share? That gives it a market capitalization of $9.25 billion as of January 7th, 2026.
And that valuation is sitting in stark opposition to the Wall Street analyst consensus. They're still anchored somewhere around $13.50.
Right. A 50% premium over the so-called fundamental targets. That disconnect, that tension is really what we need to dig into.
It is, and it forces us to ask a really specific question. Is GameStop now a legitimate, secure, cash-backed investment that's trading near its liquidation floor? Or is this stock price just an anomaly? Something totally detached from an operational reality where the business itself is frankly shrinking.
Play, almost a hybrid vehicle that's defined by this huge, secure financial floor with, just incredible optionality. The price is about the potential of the capital, not the old business.
And I'll be arguing that the operational numbers paint a much, much bleaker picture. The valuation premium you see, that massive sales multiple, is just indefensible when you look at core retail fundamentals. There are structural headwinds, shrinking revenue, and, regardless of the cash, the stock is just not sustainable long-term. That premium has to revert to the mean.
Well, let's start with the foundation of my case then, which is the cash fortress. My position is that the market isn't valuing GME as a video game store in a mall anymore. It's valuing it as an opportunistic treasury fund. Look at the balance sheet. The net cash position they reported in Q3 of 25 was approximately $8.8 billion.
It is, without a doubt, a remarkable cash hoard, especially for a company with basically zero long-term debt.
Precisely. So that cash reserve makes up almost 95% of the current market cap. What that creates is a theoretical cash floor, which just fundamentally de-risks the equity. When you buy GME today, you're essentially buying 95 cents worth of cash for every dollar you spend on a share. It changes the entire risk profile from a typical distressed retailer to something where the downside is almost completely mitigated by liquid assets. And what's more, we have confirmation of this ambitious strategy from management, the CEO's 2026 performance plan. For full vesting, it requires a $100 billion market cap and $10 billion in cumulative EBITDA. You don't get there by just improving retail sales. It's an implicit signal that the whole strategy hinges on massive M&A or transformative pivots, like their recent $500 million allocation to a Bitcoin treasury. They're willing to move into completely non-traditional assets.
I see why you think that, but I'd argue that cash pile, as impressive as it is really just masking a profound failure to execute. Let's look at the actual valuation premium the market is giving to what's left of the retail business. If we look at the price-to-sales ratio, the PS ratio, GME is sitting somewhere between 3.14 and 3.31.
That's an interesting point, though. I would frame it differently. PS ratios for retailers are supposed to reflect thin margins and slow growth. We're arguing GME isn't just a retailer anymore.
But the comparison is vital because the vast majority of their revenue, the S in that PS, is still coming from those traditional retail operations. A successful, modern retailer like Best Buy, it trades in a range of 0.34 to 0.52 times sales. So by demanding over 3 times sales, the market is assigning this premium that basically says GME's brand in stores are worth nothing, while simultaneously paying this wild multiple for the cash itself. This valuation screams unsustainable premium. It doesn't scream stability. And look at the operational decay it's ignoring. Q3 2025 net sales. They declined 4.6% year over year.
Well, okay, the top line decline is notable, I'll grant you that. But you have to acknowledge the incredible cost discipline. SG&A dropped sharply to $221 million in Q3. That move achieved an operating income of $41 million. That is a disciplined, smart reduction to stay fiscally healthy.
Cost-cutting is admirable, sure, but it doesn't solve the long-term viability problem. And that profit you're mentioning is, frankly, misleading. That reported profitability is mostly coming from non-operating interest income. It's just interest generated by that huge idle cash pile. The core business, selling things, is still structurally failing to scale in a digital world. The company is, by definition, shrinking its main revenue stream.
And that brings us right back to the cash. We agree the company's valued at a near zero enterprise value. The market gives almost no value to the retail assets. So the central risk, as you said, is the opportunity cost of holding $8.8 billion. If management fails to find a high return acquisition, inflation just chips away at the real value of that reserve. I mean, how long can they really justify holding it idle?
That is a sticking point, isn't it, for any fundamental analyst? The patience narrative starts to wear thin after a few years. Holding $8.8 billion idle is an admission that management has either failed to find a good target or that the price for any good target is just too high. In a normal company, that capital would be used for expansion or dividends or buybacks. To just sit on it while the core business melts away, it looks like a failure of deployment. It's a melting ice cube in an inflationary world.
I'm not so sure. That reasoning sort of ignores the utility that the cash provides right now. I'd call it disciplined capital allocation. They're waiting for a market dislocation, avoiding that classic mistake of rushing into a bad deal just to spend the money. But crucially, that cash is far from unproductive. $8.8 billion in a 3 to 4% yield environment is generating substantial, reliable, risk-free interest income. We're talking about an inflow of $250 to $350 million a year.
A significant subsidy, yes.
It's more than a subsidy. It's an essential strategic buffer. This non-operating income massively bolsters their net income. Q3 2025 net income was $77 million, and a huge chunk of that is interest. This buffer buys them time. It buys them the resources to fund new ventures like the collectible segment and the PSA partnership without the pressure of having to chase quarterly profit from a decaying retail business.
That's a compelling argument for the buffer, but it just reinforces my thesis that the stock price is totally divorced from fundamentals and is instead driven by complex market structure. Let's talk about institutional flows. Why are sophisticated institutional investors accumulating shares if the core business is declining? We saw BlackRock increase its position by almost 43%, Renaissance Technologies up by 94% in Q3 of 25. That flow data flatly contradicts the bearish analysts.
It absolutely does. And it suggests that those big quantitative models see something that analysts who are just focused on DCF models are missing. I'd argue they see the combination of that high safety floor, the cash, and the stock's proven volatility as a really attractive asymmetric risk. They're buying the optionality. They're buying a ticket to whatever management does next, knowing the downside is largely protected.
I would strongly dismiss that as just quantitative arbitrage. It's driven by the need for shares for securities lending revenue, not some deep belief in a retail turnaround. These big institutions know that a stock trading at 3.3 times sales with falling revenue is overvalued. They are capitalizing on the market mechanics, the shorting, the liquidity. They're not buying the vision. They're using the stock as a tool. And that's exactly why Wall Street analysts who have to justify their targets with discounted cash flow models keep those underperform ratings. A DCF calculation just cannot get you to a 3.3x PS multiple for a legacy retailer. It doesn't work.
And that divergence is the key to understanding this. It moves a conversation beyond value and into pure market mechanics. You mentioned the low borrow fee, which is hovering between 0.32 and 0.46%. And logically, yeah, that suggests institutions aren't worried about a major short squeeze.
Exactly. It signals their risk models see the hedging risk as low, liquidity for shorts is there.
I'm not convinced by that simple assessment because it ignores three critical illiquidity factors just under the surface. First, you have to look at the days to cover ratio. It's at a staggering 14.03.
And for the listener, days to cover just measures how many days it would take for shorts to buy back all their borrowed shares based on average daily volume.
Thank you. Yes, and a ratio over 10 is traditionally a huge red flag. 14 means short sellers would need over 2 full weeks of buying every single share traded just to get out. That is significant exit risk.
High DTC can be a bit misleading if trading volumes are low, though. It can inflate the metric.
It's a critical measure of risk, especially when you add in the second factor, the campaign to lock the float through the direct registration system, DRS. Retail investors are systematically pulling shares out of brokerages and putting them directly in their own names. This takes shares directly out of the lending pool, which artificially constrains the tradable supply. That's why the stock can have these violent price swings on low volume. The effective float is much smaller than what's published.
A fascinating, self-imposed illiquidity challenge.
But a real structural factor. And finally, the options market, specifically the open interest for the January 6, 2026 LEAPS calls. The data shows this incredibly dense cluster of contracts all expiring on that one date. It creates a structural setup for a potential gamma squeeze driven by hedging. If the price moves up, market makers are forced to buy shares to hedge their positions, which just fuels the fire.
But you're describing a mechanical risk, not a fundamental value proposition.
It's the mechanism by which the optionality gets realized. And look beyond GME itself. The short volume ratio for the XRT retail ETF was over 80% on January 6th. That strongly suggests there's complex hidden short positioning being deployed through ETFs, which is risk that you'd never see just looking at GME's own metrics. This is a battleground stock, defined by market structure, not standard analysis.
I think we've really laid out the core tension defining GameStop right now. The stock is, without a doubt, a battleground where these traditional value metrics, the high PS ratio, the operational decline, are clashing directly with this balance sheet exceptionalism, that $8.8 billion cash fortress.
Correct. And we also see a clash between these incredibly ambitious governance incentives, like the $100 billion target, and the very real structural market mechanics, the high days to cover, the DRS float locking, and that option setup. It all creates immense asymmetry.
My position remains that the stock price is just structurally detached from any underlying intrinsic value. The core business is shrinking, and the cash, while it's earning interest, represents a failure of active capital deployment. The valuation premium has to face reversion pressure eventually, back toward economic reality. The market is demanding action, and until that money is deployed, GameStop is simply valued far too high.
And my contention is that GME should be seen as a leverage bet on that exact transformative capital deployment, but a bet that's protected by an unprecedented safety margin. That cash floor makes the downside minimal, while the CEO's incentives create huge asymmetry if a pivot or acquisition is successful. The stock price today is the price of a call option on that future.
I think the material gives more than enough evidence to support both of our positions, which are both credible. Ultimately, whether GME is a cash-backed transformation vehicle or a melting ice cube really just depends on how an investor weighs the security of the balance sheet against the weakness of the income statement.
A judgment we'll leave to the listener. Thanks for the exchange.
Thank you.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching and see you next video. Bye-bye.